Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Calculating your federal income tax can feel overwhelming, but it's really just a step-by-step process of subtraction. Let's break down exactly how it works. First, you start with your gross income. This is all the money you earn throughout the year from every source, including your job wages, freelance gigs, investment interest, and any other income. It's your total earnings before anything is taken out. From that gross income, you subtract specific adjustments to get to what's called your adjusted gross income, or AGI. These adjustments, sometimes called above-the-line deductions, might include contributions to a traditional IRA, student loan interest you paid, or alimony payments. Your AGI is a very important number because it's the starting point for many other calculations. The next big step is to lower your AGI even further to find your taxable income. You do this by subtracting deductions. Here, you have a choice. You can either take the standard deduction or you can itemize your deductions. The standard deduction is a fixed dollar amount set by the government that you can subtract, no questions asked. The amount depends on your filing status, like single, married filing jointly, or head of household. Most people take the standard deduction because it's simple. However, if your specific deductible expenses are greater than the standard deduction amount, you should itemize. Itemized deductions include things like mortgage interest, state and local taxes up to a limit, very large medical expenses, and charitable contributions. You choose whichever option, standard or itemized, gives you the bigger deduction and therefore a lower taxable income. Once you have your final taxable income, you don't just multiply it by a single tax rate. This is where tax brackets come in. The US has a progressive tax system, which means different portions of your income are taxed at different rates. For example, the first chunk of your income is taxed at a low rate, like 10%. The next chunk is taxed at a slightly higher rate, like 12%, and so on. A common mistake is thinking that if you're in the 22% tax bracket, all of your income is taxed at 22%. That's not true. Only the portion of your income that falls within that specific bracket is taxed at that rate. You calculate the tax for each bracket and then add it all together to get your initial tax liability. But we're not done yet. After you have this number, you can subtract any tax credits you qualify for. Credits are fantastic because they reduce your tax bill dollar for dollar. Unlike deductions which reduce your taxable income, a $1,000 tax credit cuts your actual tax bill by $1,000. Common credits include the child tax credit, education credits, and credits for clean energy purchases. After subtracting all your eligible credits, you're left with your final tax total for the year. The very last step is to compare this number to the amount of tax you already paid through withholdings from your paychecks. If you paid more than you owe, you get a refund. If you paid less, you'll have to write a check to the IRS. And that's the basic framework for calculating your federal income tax. Thanks so much for watching. If this video helped you understand your taxes a little better,